Good morning, guys. So welcome to another video. So the last video we discussed about personal finance and financial independence. Today in this video we'll discuss about the magic of compounding and something about the stock market and how we can use this principle of compounding in the stock market and make money. So let's get started. Before we begin to talk about the magic of compounding, I would like to say something about the stock market and how it works. Otherwise, applying the compounding process into the stock market would be impossible to understand. So what is the stock market? Stock market is a place where the companies, big companies, register their shares, and we as retail buyers, retail traders, buy shares from the stock market, sell shares, and make some money out of it. So these companies which have registered their shares in the stock market is open to the public. The public can buy these shares and sell these shares. The price depends upon the buying and selling ratio. So essentially, the price of a company is decided by the buying power and the selling power of the people who are buying it and selling it. So it's a trading platform where shares are being traded off. In order to fully understand this concept, you'll have to deep dive into it, which I'm not going to do right now. A lot of billionaires have had their wealth increase or had their wealth sustained by the stock markets. A lot of my previous generations, example my father or my grandfather, may not have heard about the stock market or maybe had a negative sentiment about the stock market. But me, when I came into this and when I learned about the stock market, I feel that it is something to be learned and it is something to be understood, because this is the only way to actually sustain your wealth for the next generation, or to grow your wealth and to sustain it. Growing your wealth is something different, creating wealth is something different, and sustaining your wealth is another whole different topic. So our forefathers, even my father, has sustained wealth through real estate, to buying land, keeping it and holding it for a longer period of time and selling it for a higher price. That is the way that my forefathers or my father has made money or have made money. So buying a property right now is very difficult, and you need a lump sum amount of money stored in your bank account to buy these properties. So the next best option is to buy stocks or buy shares of good companies and hold it, just like you buy real estate and hold it, but you can buy a fraction of the share. So basically, stock market is a place where we buy and sell shares, and we make money out of it, the company makes money out of it, the company gets capital to grow, our money to grow, and in return the company grows and the share prices grow, and we make money, the company also makes money. So it's a win-win for both of them. So you need to be careful while investing, because this is a risky game. You need to do your own research, do research on the companies you're investing in. You need to believe in the companies you're researching in, and you need to make an informed decision before investing, because in any investing method, even if it's real estate, you need to do your own research. You need to go to the place, see the plot, look through the documents, see everything if it's legit. If everything is up to the mark, you buy the land. The same way, you need to do research on the companies you're buying, and you need to make proper informed decisions before buying stocks or shares of a company in the stock market. So stocks or the shares which are being bought are listed in the stock exchange, which is in India is basically NSE and BSE. NSE is the National Stock Exchange and BSE is the Bombay Stock Exchange. So these two are pretty much similar. So all the shares are listed in these exchanges, and we can buy stocks or shares from these exchanges. So there is no paper trail. It is all electronically done in real time. Earlier days it used to be paper, and buying a shares usually takes around 1 or 2 days for the order to come through, but right now it's all instant. We get it done very easily in a second. So when we buy shares, it's all real time. So you can buy shares, you can buy stocks of companies by three methods basically. One is the mutual fund way, the second is the index investing way, and the third one is the direct equity way. So mutual funds are funds which are managed by a fund house or a fund manager. So you basically give your money to somebody else who will be managing your money on your behalf, and that person will take a cut out of it. Say a percentage of commissions will go out of it. So if you're a person who has limited knowledge or no knowledge about the stock market, or you don't have the time to research about the companies, or you don't essentially know anything about the stock market or investing or how to manage your money, just give your money to the fund manager or the fund house and they will do it for you, and you'll get some return out of it, and along with it the person will also take a commission out of it. The second method is index investing. Index investing is something where there is no mutual fund manager or mutual fund house which is managing your money. You just invest your money in an index. An index is basically a computer generated a software which follows the Nifty index. For example, the Nifty 50 follows the first 50 largest in market cap companies. So your money will be invested automatically into all these 50 companies. So there is no actual tracking which is going on. It just tracks the index and it just invests in all these 50 companies. And when these companies grow, your funds also will grow gradually. So this is another type of investing where there is no actively managed funds yet. It is all passive, and it just tracks the index and invests the money blindly to all the first 50 largest companies. The third method is direct equity investing. In direct equity investing, what happens is you need to invest your own money, do your own research, and make your own returns. So I find this more fun and I find this more engaging. The returns you make are your own. You don't have to split it with anybody. You're proud of your research and you can invest in the companies which you actually believe in rather than somebody doing it for you. So there are three types of investing methods: mutual fund investing, index investing, and direct equity investing. In order to buy shares, you need to open a demat account with your broker. So there are a bunch of different brokers. Brokers are not physical brokers. These are all electronic, all e-brokers basically. So it's just like an app on your phone or a computer. You can open it, register in it, and buy your shares from these apps. So demat accounts are opened by these brokers on your behalf, and they hold your shares on your behalf. So you can buy and sell these shares through these brokers from the stock exchange. There are a lot of brokers like Zerodha, Upstocks, Grow, HDFC. I personally use Zerodha, which I find very economical, and they have very low rates, very low commissions, which will help you in the long run. The reason I'm stressing on stock market investing other than all the other investing methods is because I find this very intriguing, and I'm not a finance guy, so I accidentally plunged upon investing and other methods of investing, and I wanted to learn more about. I was very curious and I just wanted to learn more about stock market investing, and I was in awe seeing all the billionaires who have made so much money from the stock market. And every billionaire you see, every millionaire you see, everybody who has made a fortune in their lifetime has made it through stock markets. And the people who have already made a fortune sustain their wealth through the stock market. Yes, buying land and buying real estate properties also classifies as buying assets and holding on to generational wealth. But stock market is a whole another game. If you buy good companies and if you hold it, the percentage of returns you get is twofold. If you hold the right companies for the right amount of duration, or I would say indefinitely, you would make a lot of returns. SIP and lump sum are the two investment types which you can do. SIP is a systematic investment plan, and lump sum is where you invest a lump sum of money into the stock market. The difference between these two are SIP is done on a monthly or in a specific interval where you don't time the market much. but lump sum can be quite overwhelming when investing in the stock market, because you need to time the market up to a point, because when you invest in the market, when the markets are overvalued, you'll be losing a lot of money. So you have to be cautious while investing a lump sum amount of money. But investing in the SIP method, it will be much better for the new investors, because it won't give you much of a hit to your investment portfolio. So I personally do an SIP mode of investment, where I invest something every month into the stock market, which is also called as a dollar cost averaging method, because your money is averaged. So even if the markets are high, the next month it is expected that in a 12-month period, the high markets will be around 3 to 4 months and the low markets will be around 5 to 6 months. So it averages out. Okay guys, so I would like to talk something about the magic of compounding. So since we have learned about the stock market, now I would like to implement the magic of compounding into this equation and see how this works for us. So magic of compounding will only work if you have a bit of time at your hand. So that is what I mentioned in the early video. You need to start early, because time is the single most important thing in this equation that helps you grow your money. So time will grow your money. You just need to give it some time and wait for it to grow. So index investing, as I said earlier, has given a return of about 12% in the past years of the stock market. So when we're looking at the history, if you're investing in the index fund is something where you don't need to do any research. You just invest in the first 50 companies first 50 best companies in the stock market. It gives you a return of around 12% if you invest it for a period of say 10 years. So that is what the history says, history gives us. So it is expected that it will give you an average of 11 to 12%. So we'll take that into account here. We'll do an index investing style form, and we'll not talk about equities or mutual funds. We'll just talk about the index investing, which will give you a basic return. It is not too high, not too low, it's in the middle. So we're expecting that we'll get a 12% return from the stock market. Say that you invested for around a 10 period time frame. So we'll just take a look at how our money grows. We'll take a look at how our money grows in both lump sum investing form and an SIP investing form. So this is a SIP calculator here in front of me. So a monthly basis, if you invest say around you have a normal job or 9 to 5 job, and you make around 80,000 a month, say approximately 80,000 a month. If you can invest around say half of it, say 40,000 a month, 40,000 a month, and you're expecting an annual return of about 12%. 12% is the basic return you get out of the stock market if you're index investing it. So a tenure of say, we're going to do it for 15 years. So no, we'll do it for 10 years first. A 10-year period, 40,000 a month with a 12% annual returns for 10 years. We're not equating to any increase in the amount of investment, because 40,000 is not going to be the investment every month, because it's going to increase. You're going to increase because you're going to change your jobs, you're going to better your lifestyle. So things will change, but we'll keep it to a constant, and we'll say 40,000 a month every year for 10 years. So that will come to around 92 lakhs, which is almost, so the total amount invested will be 48 lakhs, earnings will be 44 lakhs, and your future value will be around 92 lakhs. 92 lakhs is around a crore. So 40,000 a month for 10 years will give you 92 lakhs. Okay, so we'll just change this to a 15-year time span. So when you change to, so the amount of time, the amount of wealth you create in 10 years is 1 crore. So the expectation of this wealth increasing in the next 5 years span would be around say 20 lakhs or 30 lakhs, but when you check it out, your wealth will grow to around 2 crores, okay, in a 5-year time span, because this happens due to the magic of compounding. Compounding occurs, so this occurs due to the magic of compounding. So this is not magic, this is actually mathematics, because your principal amount, the interest which is earned every year or every month, is added onto the principal amount. So the next interest will be of the principal amount plus your interests, and the next year will be principal amount plus interest plus interest plus interest. So the interest keeps on compounding with the principal. So that is the magic which happens. So when the time goes on, when the time passes by, this process speeds up. So the amount of wealth you created in a 10-year time span will be created much faster with time. So if you take a 10-year time span to produce 1 crore rupees, this will happen in the next 5 years. It will just go on to become 2 crores. So the initial time frame is what is difficult to achieve. After that, it just becomes easy. So you just need to hold on to your money and just let it compound. So let's just see what will happen in 20 years. So you hold it for 20-year time period, and you expect the 2 crores to become what? You expect it to become 3 crores? No, it becomes 4 crores. Okay, so your money which you have invested every month with just 40,000 a month with 12% annual returns for 20 years gives you around 4 crores. In the first 10 years, if I had given you just 1 crore, in the next 5 years it gives you 2 crores, and in the next 5 years it gives you 4 crores. So it just quadruples every 3 to 4 years. So when I give this, say, a 25-year time span, it's going to be 7 crores with just 40,000 a month. So this is called the magic of compounding. So I hope you have understood something about the magic of compounding and something about the share market and how things go by. So we'll do a detailed video about all these later, but this is the gist of it. I hope you understand. I think you have gotten some motivation out of it. And if you do like the video, please subscribe, like the video, please share it. And if you don't like it, just ignore it and click something else like always.